1929, 2000, 2008, and 2022. What do all of those have in similarity? Well, a data point that we're seeing now in 2025. Could it be that this year is going to be terrible on markets? Well, with inflation becoming the new big concern as we see a strong jobs number, we need to talk about it in today's special weekend edition. Yes, guys, we've got breakouts in some of the metals that we've been discussing. Oil's going ballistic once again, and many markets are almost about to crack. So what's really going on? Do we see big dark pool transactions coming in from Wall Street? And of course, what should we be looking at into the next weeks and months? We've got the data. Let's break it down right now together. See you soon, guys. This one is not to be missed. Well, welcome back, everybody, to the Daily Show. This is our special weekend edition. My name is Tom, and there is a lot to go through because, of course, we know that this will matter what happens in January and Q1 of 2025. It did see some breakouts to the downside after the jobs numbers, but before we get into any of this information, I just wanted to give a thoughts and prayers shout out to everybody that is involved in these horrendous California fires. Yeah, they look really bad. Obviously, I'm from Australia, but what we're seeing here on the news and the television and everything like that looks horrendous. I've already had members of the community reach out with their stories, and I've got to say, it's mind-blowing what's going on. So I hope you're safe. To anyone that's affected, I'm sure I speak for everybody here that's watching that gives their thoughts and prayers to each and every one of you, for your families, your friends, and of course, hopefully your houses are safe as well. Speedy recovery, guys. All right, let's go through to the markets though, because what's going on there is also a little bit bad when it comes to breakouts. Yes, US 10-year is breaking out. And as I've alluded to and we talked about in our previous video, we know that when the US 10Y breaks key levels, like it did during these times, and it's always about the fear of the unknown. So remember, the fear of the unknown is what markets absolutely hate. Whenever we've seen these kind of breakouts of previous periods, that has tended to be with a downward momentum. So recently we saw this, which is of course the trend line breaking up on the US 10-year, and the stock market, as that trend line came through, started to sell off. We've already talked about this a few times, but now we've broken this high. If this sustains, then we could be looking at further pullbacks. This is what started the 2022 pullback with, of course, concerns about reinflation. We then saw a break of a new high over here, which coincided, as you can see, with further dipping during 22 into 23. And then we saw a new breakout here in yields, which is the red bar, which caused the famous dip kind of 23 into the October lows, which were then bought up. So is this happening again in 2025? Is this a concern? We'll go through that chart later on, but let's look at the warning signs in terms of the bigger, broader data. First up, generally it's not great if stocks break December lows, and it can be a significant warning sign. Now, the December low sits at 58.67, and as you may look on your charts for the S&P 500, you will notice that we have actually broken below that point. Now, when we tend to see this, the stats are not so good for the full year, and they're actually not that great for really any period of time in the markets for that year. It starts to build that evidence that things are going to be up, down, and all around. And this is what we already thought about 2025, possibly that we could go bullish for about 6 to 9 months, and then we might see actually a bit of a sell for the rest of the year, and that we would probably get a very weird up and down market. Now, Q1 of any new Republican kind of presidency, that also brings similar stats. If you go back about 3 videos ago, you'll see some data that we shared on that. So first up, is this a concern? The short answer is yes. It's something that we should consider, along with the Santa Claus rally, along with, of course, toy barometers and other things that we use at this time of year. Remember, it's about building the evidence of either a bullish case or a bearish case, and then bringing that together with the price action and the technical analysis. Now, what about that stat that I read off at the start of the year, or to do with the markets when we've seen bigger crashes? 1929, 2000, 2007, and 2022. Yeah, this is an interesting one. S&P 500 after at least 4 losses of greater than -1% in 10 days within a 30-day record high. Now, this is a bit concerning because when this tends to happen, as you can see here, the data stats for the rest of the year, 70%, it's actually right on, if not slightly worse than what the market usually gives you. But more importantly than that, it starts to bring in some of the worst data points. And these are the ones that everyone always freaks out about every single year. It's not to say that we're in that yet, but we certainly need to be paying attention to, again, building the evidence, which we'll do in today's video each way. So is this a bad record? Yeah, it's not a good one, and it certainly needs to be paid attention to. Let's now talk about these jobs numbers, though, because on the surface of it, you'd think, wow, strong economy, great jobs numbers, fantastic, yeah? Yeah, but as we know, the market has been pricing in a certain level of rate cuts. The market's been saying, yes, we're going to get lots and lots and lots of rate cuts to help support all of our thesis on markets in 2025. And that is going out the window. Look at this jobs number here, very strong, 256. The expected was 164K. And we actually saw the revisions, which we posted over on our X account, links in the description down below if you want to follow over there. We do share stuff. As October revised up 7K and November revised down 15K. So basically 8,000 jobs lost over those 2 months. These numbers are all kind of fake, so they get modified all the time. But still not as bad in the revisions that what we've previously seen. So what this is doing is it's basically going to the market and saying, you know what, there's no chance we're getting a rate cut anytime soon. And it looks like, therefore, US 10-year is going ballistic. Now, US 10-year usually is correlated with a few market areas, one of those being energy. And as we've seen, energy has been breaking up now for about 2 or 3 weeks and going very strong. So if that continues to break out, could this be a concern forcing markets down further? It certainly could be. Let's now go over to retail sentiment, because that is shifting to the downside as well. We'll notice here that retail sentiment has gone 37.4% bearish over the last week. Now, this is a reading that is taken as of Tuesday close. So, of course, we haven't even got this new bearish movement. So you can imagine that's probably up near 40% now. We've got less people neutral and, of course, less people bullish. Now, if you're a contrarian, this is where contrarians start to get very excited about the markets. Traditionally, when you're getting close to these kind of 40% bear reads and you're seeing bulls really get sucked out, that often means the bull-bear spread is low, and that can be actually a good signal for buyers. So I guess on the plus side, a contrarian will look at this and say, well, that's good. Regardless of those data stats, that looks good. Now, of course, ever the contrarian, or ever the bull really, Tom Lee has come out and he said, don't worry, guys, it's all okay. Our equities look good and everything looks good. And he's actually advising people to continue to double in on this idea of small caps, cyclical sectors such as financials and Bitcoin. Now, financials are an interesting one because, of course, they would benefit from deregulation. Remember, a lot of the issues here that we're seeing is people are quite concerned about tariffs. Well, you know, a tariff's going to be blanketed on everything from Trump, or are they going to be on specific areas? We don't know these things. Of course, we can assume. But generally speaking, I think the main takeaway for Trump is probably deregulation is probably one of the big areas, and I agree with that. And then I think a lot of us would probably also agree that there's meant to be tax cuts. Now, if we do get both of those, you'd have to think that is actually at least a sugar rush for markets. So regardless of all this negativity around markets right now, these two policies themselves, other than the tariffs, they could still force a market to go quite bullish, at least initially. Let's also take a look at the jobs numbers together here. As jobs markets go up, do usually stocks go up? Well, yeah, 80% of the time they are very correlated. Stocks up, jobs up. As you can see here, stocks down, jobs up sometimes, does happen. And of course, stocks down, jobs down. Yeah, we don't want jobs down too much. So what you're usually looking for is a bit of a yin and yang with markets. You're generally looking for a slowly growing kind of economy that then the Federal Reserve can juice by cutting rates, by doing other liquidity things. Now, the problem at the moment is that you've got all sorts of problems coming for the Fed. You have, of course, delinquencies, that is bankruptcies, going up across the board. We saw that with credit card numbers recently. We've also seen that with just general filings starting to uptick again here into 2025. And that means that, the Fed is going to also want to cut because they're trying to get their rates down. They're unable to do this. So the issue is that the market's confused about what is the Fed going to do? Is it now going to hike? I don't think that's likely, but that is now becoming the consensus by some of these experts out there. In fact, BofA just reported, that's Bank of America, they just reported that they believe the next move will be hikes. I think that is not going to happen. I might be out of school there, but I did see a report on it. What do you guys think? Do you think that the central banks will be hiking again before they're cutting? Or do you think they're just going to hold it for as long as they can? Remember, they held it for ages, started cutting, was probably too soon. Now we're starting to see people's call for hikes. I don't think that's likely either. I think they just hold it for longer. Let's talk about the good stat, the first 5-day stat. Now, we know here that when we get first 5 days of the year trading positively, that is a great bullish sign. So, of course, we've got two kind of negative signs for this year. We've got the Santa Claus rally as well. So you kind of have to put 3 in the bear column at the moment. And we've got 1 in the bull column, which is the first 5-day stat. So that's kind of good. As you know, many people do use this stat. You can see here that FundStrat also uses the stat. And when you're over 1%, or you're actually even better, when you're over 0%, then you're good for the financial year. But still, the first kind of area of the market, that is January, notice the stats are really different, by the way, for these 5 days. Look at this, 61% of the time. So not that great for the first quarter. The first quarter is looking very shaky for this year, and you're going to have to be quite disciplined in your trading and investment scenarios. Another one that's looking good for the bulls has to be consumer staples. I mean, look at this, staples versus the S&P 500. This is basically saying that we are looking at a defensive sector of the market versus the SPY. New all-time lows here. Now, that's not usually conducive with the market that's freaking out. Generally speaking, you will usually see staples starting to pick back up, healthcare starting to pick back up, and utilities as well. And while utilities has done okay and healthcare's come through a little bit, that's usually what you're looking for. You're also generally looking also at things like high beta versus low volatility spreads going to the downside, not going to the upside like they are right now. So traditionally, these are actually reads that you get in bull markets. And that's why you've got to be really careful about instantly calling a bear market here. Have many things changed? We've got strong jobs numbers. We've got, in general, kind of like an administration that's coming in that's meant to be pro-market. Obviously, there are some concerns about tariffs, but in general, really not that many things have changed. We haven't seen full cracks appearing and everything going absolutely diabolical. But regardless of that, only 11% of the S&P 500 stocks are currently in an uptrend. According to Grant Hawkridge here, give him a follow if you'd like over on X, while 46% of these stocks are in downtrends and the rest are kind of muddy through and through. So this is kind of showing you again that the breadth of markets is pretty poor. US rail traffic, something that you can always look at to see whether markets are actually telling the truth. I like tracking rail traffic. We've done this a few times over the last 2 years. And you can see here that cars versus 2024, again, we're still seeing good numbers. The American consumer in general is spending. They're buying. People are buying. And although things are softening, people are still buying. Surge in bond yields usually triggers a sell stock off. This is similar to the one I shared over on X before. And you can see here that markets hate yields spiking up. All right, well, before we go into the dark pool liquidity and we take a look at that, let's just quickly check out here the Bitcoin flows. So we started to see a few updates here. Bitcoin's still getting positive 7-day flows. Ethereum was down to negative on both. And the last 24 hours leading into the close were obviously short. So that's no surprise considering where we're at. We will be looking for huge inflows into the cryptoverse and some big dark pools if we can get them. But let's talk stocks here, because while cryptos are really more of a technical play here and looking for flows, let's see if we've got any reads from the dark pool side. Now, this is a good one here in terms of SOXs. So this is the Semiconductor Bear 3X Fund. And what you'll notice is that we got a large dark pool transaction. And over the last 7 of these reads, we've usually seen a pretty big pivot point. Now, it could be a pivot point towards the upside, don't get me wrong, which would mean bearish semiconductors, or it's even possible that it could go towards the downside. Now, at the moment, considering the supports that we're on, we'll show you those soon. Of course, we'd like to see it towards this side. So basically that means that, the market's finding some buying pressure. You'll notice here that they have been pivot points though. So clearly something big is about to occur. Let's look further into the dark pools. Near the close, ProShares Ultra Qs. Now, of course, this is a 2 times leverage Q market, 2 massive dark pools. One of them is a sweep, which usually means they want quick execution. So that came in just as the market made new lows. So this can often be a bit of a trap towards the bears as well. So the markets obviously look really bearish in terms of the way they close. They look pretty terrible. We'll look at it in a moment. but we still get all of these random transactions. Here's another one here, very large, big transactions coming through for the S&P 500 3x leverage funds. And you'll notice again, they're right near the close, exactly where you kind of start to see the Wall Street, or at least near the lows, where you'd see Wall Street usually transact. And you'll notice that they transacted the other day, markets rallied up, they transacted on this day. Will we therefore get a rally onto Monday? Here's another one, Nvidia getting another large transaction through it. Not as big as last time, but there was one here, a little bit of buying pressure support, fell lower, 135. This is a critical zone, as we know, on the options and technical levels, and we get a big one coming through. So a couple of large transactions certainly starting to appear on the markets, just like we've seen some really large transactions come through things like silver and gold recently. And both of those, and energy, and all of those have actually led into relatively nice moves. Not a guarantee, but certainly a key point for us to see the reaction. As we often say on this channel, patience, react, don't predict. That's what we're looking for. Let's take a look at the last 5 days. Energy best, gold second best, and then healthcare coming through with the goods in terms of third best. Even with all of this selling and buying and all sorts of stuff that's going on, you'll notice semis are still eking out an overall gain, which has been one of our favored sectors recently. And you'll notice here that staples are still down, as are the financials. So generally speaking, you would look for the staples and more of the defensives to come through if this was a true sell-off where the market was totally freaking out. Let's now talk about the worst down case scenarios right now without any buying pressure. Well, first up, did we close below the best kind of indicator so far, which has been the weekly 20 moving average, mean reversion? Well, here we gapped below, but we didn't close below. Didn't close below and closed right on it. So we actually closed on one of the major supports, even though it looks like on the daily things got bad. So it's right on that zone. Now, could we go down into this 56, 57? Yeah, that's certainly very possible, as you'll see in the options in a moment. And we certainly caused like a waterfalling effect throughout the Friday of trade thanks to those big options. Let's move over to the US 500 though. How's it trading? Well, again, you can see here, it actually sold further after hours and pushed into these low levels, these low wicks, which were the lowest points we saw where generally buyers had come through. There'll be a lot of stop losses under here, guys. So this could be an execution of those stop losses. We still want to remain generally bullish as long as we can hold these 57s and 56 levels overall, if you're looking at higher time frames. But for shorters, I think you'd be okay. You'd be kind of confident in trying to get it down to these two levels and then reassessing your situation. This is certainly not a good candle. And if you think about it, if you made this a 2-week kind of candle here, this would be effectively a long leg doji. This could be considered a decision made towards the downside. Certainly a lot of negativity on the markets here thanks to those yields. And you'll notice on the daily, the worst close. So I always say the close is the key. It's a series of lower highs and lower lows. That's not good. It does generally signal that this is a real possibility this week. Let's have a look at the options now. And as we know, this is kind of important level, 5,800, 5,790, 5,800 has now become the overwhelming put strike. We're in negative gamma, I think, on almost every sector in the markets at this stage. So everything is technically bearish on the options flow. And we're looking for really, has Wall Street come in to buy it up? Now, nothing's changed when it comes to the 17th of Jan. We still have this huge 5,900 put. And I think the 5,800 will become bigger. So effectively into this OPEX, what's going to maybe happen is we might hit 5,800, see a buy, and possibly even close above 5,900 into this week. So this is something that is a real distinct possibility just based on what we've seen traditionally puts do throughout 2024. And unless this year is going to be totally different, that would be something that we would look at. So 5,800, 5,790, certainly a key level of potential supportive pressure. And because we know dark pools came through close to these levels, if they continue in our next video, make sure to subscribe for that. We will be looking because that will be a very good tell. That's when you're starting to build an edge case in terms of getting some form of actual statistical probability. And in this case, I'd probably be like, if I wasn't already in the markets, I would be looking for a new sign. Now, that sign is probably going to be like a supportive 5,800. You get that, great news. Big dark pools, great news. Stack the evidence, see the price action. You don't have to get the lowest low. You just need to get the momentum. What about Tesla? 400, still kind of stuck in the middle of nowhere, as you'll see, but they are the options levels for you guys. and 130 is kind of the bottom end here for Nvidia. You can see that 150 was too much for it again. 145, the most struck level for this week, and 140 struck the week after. So basically 130 is probably the base for Nvidia at this stage. And let's jump on over to this one. I know it's a white screen, but it's just the one I used for taking the picture. And as we know, this is a very important level. There's no doubt that these yields breaking out is one of the worst signs that you can have on markets. And I don't think that I would be ultra bullish on picking a position until we see a reaction. So if you're in the markets, I don't think I'd be terrified as long as you know that 56, 57s are super possible. But if you're not in the markets and you're saying, oh, I want to buy this dip, yeah, you probably want to pay attention to some of these things. Let's move over to why the US 10-year is so bad. First up, we've got this downward trend line. We already know that broke out a little while ago. As you can see here, broke around this point in December. Then since then, it's gone strength to strength to strength, and it just got through 4.7. So this is not traditionally where you've usually wanted to say, wow, this is a great buy the dip. Traditionally, what's happened is yields have kind of continued up and then they've moved down. Now, the read for this may come from the wrecking ball of all of this kind of discussion, which is the US dollar. So you can see here the US dollar has continued that strength up. Now, we know that if the US dollar goes to where we think it's going to go, 110.76, that's going to put further potential downside pressure on the stock market. So this is the wrecking ball. We certainly haven't been bearish on the dollar. We've been looking for a sign of it turning. We just haven't got it yet. So at this stage, the wrecking ball of the US dollar continues to be the struggle point for the markets. And it certainly doesn't look like at this stage it's slowing down. I mean, look at that. Very strong rejection off the low, closes at the new high levels. So pretty strong candle. What about the bonds? Well, when we're looking at bonds, we already discussed the idea that maybe the most freak out level of the bonds has already occurred. And you probably read in the news, everyone's freaking out about treasuries, but that's only one section of the bond market. Remember, we need to look at corps. We need to look at bonds in reflection of the overall yields. And when I do that with some of the reads that I've got here, you can see that it doesn't look like, it's not great, but it doesn't look like a terrifying kind of market. It doesn't look absolutely diabolical. Now, if you put in treasuries and you take a look here, this is the one that everyone's discussing. I would not rebuy treasuries unless they take that 88 level. We haven't actually seen huge transactions come through that are supportive. We got some really supportive ones in here. The market rallied. The market has since dropped through that level. And remember, based on the dollar, based on yields, we've just got to reassess. Patience, react, don't predict in this case, and make sure that levels are actually being broken to the other side. Let's get that momentum back into the bulls. What about gold? Still looks good. Obviously looking for a 27.25 kind of breakout to really get the gold movement going on. I'm pretty bullish on gold this year. Obviously, I've got 3,000 still on my target list. Plus, I'm thinking even higher for gold if this goes through. And yeah, really gold will do well if you think we're going to a stagflation environment or even still a cutting yield environment in the future. Silver did okay, managed to close again a little bit more bullish. Weekly looked pretty solid, closing at the weekly 20, but did hold these wicks, which is cool. And yeah, we still like silver. We've seen some dark pulls around that one. What about oil? Smashed through that target zone. Could it be going towards the next target zone? This is certainly a resistance as well, but oil on the uptick at this point. And of course, we first started talking about that down in here in December. So it's not a new story, though it's coming through. And if you're on the oil train, maybe you've taken a little bit of profit off, but you're probably still holding some long and saying this looks pretty good. Tesla, yeah, hit the major first support, 380, found a little bit of buyers, stuck somewhere between 450, I would say, on the high end. And I still think that there's a good chance that Tesla could move down to 340. So I'm not a strong buyer here. We'll reassess maybe at 425, but if you like 380 and you bought it, you'd be happy and hopefully holding towards 420. What about semiconductors? They're back in the most traded zone. They're still holding up relatively well over the last 5 days. Very important we see buyers come in here. Nvidia, you can see coming down to that 134, hitting our level of support, finding a little bit of a buy, ending as a doji. No evidence here that the market is super terrible or anything just yet. Of course, the sell-off, definitely squeezing a few people. Let's see how Nvidia trades through the Monday session. AMD failed to break that 132, which is going to be our super bull buy. We obviously saw a large transaction over here. I would guess based on what I saw, a lot of transactions did go through these. If this now goes above that 132 in the future, that is going to be a super buy. AMD will be on our watch list if that does occur. For now, yeah, the low steel is going to wipe a lot of people out, and we'll see what happens. What about China? Not the best. I mean, taking a new low is not great. CN10Y continues to go down. Obviously, markets are struggling here. We'll reassess this. I'm not super bearish on it because it's almost completely oversold now, but we will have to rewatch. And we haven't seen any day trade bids yet, so we're looking for that bids. But US 2K got through that first good buy zone, which obviously I still like, and got no problem with that area. It's only down. Was it even down through that? 2%. It's not that bad for IWM. So yeah, I still think it's at a pretty interesting level. This is not a good close. There's no doubt that when you look at this, most people are going to say flag, down, take the length, and they're going to all go towards 2000. Now, if that happens, yeah, we're looking at that more significant sell-off in markets. And this is, of course, what most people are going to be freaking out about this weekend. We just don't know exactly yet. Remember, the US 500 held the weekly 20 barely, but it did hold it. We had those weird transactions near the end and through the day. So we also saw, of course, that buying at the end, because this is buying at the end. That's aftermarket, these red candles. So possibly Wall Street has swept the lows, and we've got to watch that. For the NASDAQ swing traders, you guys just need to keep holding these two levels. 2120, you want to look at that for bull buying, and you want to look for a break of this downward trend line. That would be incredibly significant in terms of bull buying. I don't know if I'd buy right here on the dip. I'd probably wait for the evidence. Yeah. Would I sell right here? A lot of people are going to say, I'm short. Haha, this is going down, man. It's possible. I mean, look, these are not great closes. They're really those really close to call ones. So the biggest one's probably the S&P still daily close low, and that's not great. Certainly, I wouldn't just buy the dip here. I'd have to wait for evidence. No way. I think the chances of 57 still become possible. 58's where the puts are, though, on the S&P. Let's have a look now at crypto. Solana right through the support, just sitting there doing absolutely nothing. Ethereum still doing nothing really at these lows. You might say, well, that's really terrible. It's actually just holding around the same zone. Each time it's selling off, it's not making a higher high, though. It's making a lower high. So lower high, lower high, lower high, lower high, lower high. Need to see higher highs. We'll reassess this in our Monday open live stream. So make sure to join us and see what happens there. And the big one, Bitcoin, still holding. So this is such a critical zone for Bitcoin. It has to hold this 88.92 zone. So far, so good. Let's see if it can continue to do so. And if it can, then we could still be in a bull market. So a lot of people are losing faith in these things. I had people calling me and messaging me and all sorts of things over the last couple of days, freaking out about the crypto markets and stuff. I think that's always a good sign that fear has come in heavily. The question now is, can we actually find a reason to really want to be very bullish? So the data points for 2025, let's summarize this. Way worse than 2024. So much worse. So this year is going to be tough. There's no doubt there's going to be tough buys. It's not going to be just like buy the dip, everything's fantastic. It's going to be a lot of sideways action, a lot of you being patient and sticking to your rules. The other thing I'd say is that while we are getting some okay reads, it's just going to be like one of those ones where you probably want to be a little bit faster in markets and look for sentiment shifts in sectors. And we will be doing that together. So already we've seen sentiment shift this year towards metals and energy so far, and gold has particularly done well, and silver. And then I'm sure we'll see shifts into healthcare and shifts into other things. We don't have the traditional cracking signs of a market just yet, so we have to still remain, relatively speaking, bullish, but we'll give our full summary in upcoming weeks. Core PPI this week, Tuesday, January 14th at 8:30 a.m. New York time. We've got the CPI, which will be important, of course, which is at Wednesday, January 15th. So that could push the market around quite a lot, guys. And then core retail sales, which you probably expect to be relatively strong. The market's obviously thinking it's going to be pretty good coming Thursday, although those credit card spend levels were down. So yeah, still a bit of news, obviously a lot to cover. If you're interested in finding out more about what we do, check us out in the links in the description down below. There is a lot going on in markets, so make sure to follow us over on X and follow me on LinkedIn as well. I'm doing a bunch of psychology kind of reports and write-ups that are different from what we do here, which I think if you want to take trading and investing seriously in 2025, you'll really want to read. So follow us in LinkedIn as well. specifically my account if you're interested. Thank you so much, everybody. You have a fantastic weekend. And of course, stay safe in these markets. And yeah, make sure to practice risk management. This is the year you don't want to be as heavily levered. All right. Catch you for now. Bye, guys.